It's time for Trading Strategies. I'm Scott Gamm. The S&P 500 is up over 1.6% so far in August, flirting with record highs, but don't get too complacent. We still have 3 more weeks left in the month, which is historically a down month for stocks. That's why we have a plan of action for you from our 2 market all-stars. Let's welcome back Kristina Hooper, Chief Market Strategist at Invesco, and Stephen Guilfoyle, a real money contributor and co-manager of TheStreet's Stocks Under 10 portfolio. Guys, it's great to have both of you back here. Thank you.
Great to be back.
So what do you make of the gains we're seeing in the market so far this month? Will it last, Kristina?
My expectation is that we're going to see volatility, and ultimately we're likely to finish the year at nothing above 29.50. But we're going to work very hard in the next month and several months, I believe, just given the expectations of more and more fluctuations that I have.
29.50, I think we could live with that, Sarge.
I can live with that, except I think it's going to go a little higher than that.
Above 3,000.
Very possibly. I mean, what does Tony Dwyer picking? Something like 3,200,
yeah.
I think.
And he was at 3,100, I believe, earlier this year.
You know, I don't know if I can be as aggressive as Tony, but the corporate buybacks are a big story. And what's up to $1 trillion, I think, in commitments, authorizations rather. And I think the macro picture is there. The earnings picture is there this quarter. It's going to be there in the third quarter, and it's going to be there in the fourth quarter. So earnings per share and revenue growth is probably going to be there the rest of the year. Now, we have the hiccups. We have the hiccups, the tariff story, and a few other stories that might work against us. But I do believe that in the end, we probably will see higher equity prices.
And Kristina, what do you think of the buyback factor?
The buyback factor is powerful. But having said that, I would argue that tariffs aren't a hiccup. They're dysentery. This is a huge, huge issue. It has not been priced into stocks, but it actually has the potential to really send stocks lower. Now, I don't expect stocks to have a huge sell-off this year, but I do expect to see a lot of volatility. And when I say 29.50, I think that's the high end. I think we could finish as low as 28.50, maybe even a little lower at the end of this year, because I expect so much in the way of fluctuations and concerns.
Does 29.50 include tariffs? I guess what degree of tariff issues does 29.50 include in that level?
Well, I think of tariffs as death by 1,000 cuts. There's not a day when Americans wake up and say, oh my gosh, this tariff situation is huge, let's send the market down 20%. What I instead expect is that slowly we see an erosion in confidence and an increase in concerns around stocks. Of course, there is the potential that we get diverted, that something stops this train from getting to a point where we really are in full-blown trade wars. But I just don't see that happening right now.
Because, Sarge, we still have plenty of tariff headlines, yet the market doesn't really react to that as it used to a few months ago.
Yeah, we grew calluses. And you might certainly be right. I mean, I do believe that the trade war story is potentially much huger than we're giving it right now. I do think it has somewhat suppressed the growth in stock prices that we might have seen. So I think we are pricing it into a minor degree. And I'm going to hedge myself accordingly, because I always do, and I always understand that I might be wrong. However, I'm on the record saying this. I know probably most people disagree with me. I do believe that we can win a trade war with China. And it might hurt. Now, I'm a serviceman, okay? I'm okay with hurting for my country. I know a lot of people might very strongly disagree with that. If we go through some pain, in the end, wages are higher and the overall economic condition is better, then I am willing to go through some pain and even lose some money myself in order to get there.
Okay, that's an interesting point, because, Kristina, China's economy is showing some cracks, right? Some of the economic data, PMI, things like that, are not as strong per se as some of the data points we're seeing here in the U.S. We just crossed 4% economic growth in the U.S. President Trump thinks that can go to 5 or 6, which wouldn't be that far off from where China economy is doing. Can the U.S. win a trade war with China?
I think it would be very hard for the U.S. to win a trade war with China, because China is far better equipped to play a long game. Absolutely. I think that the United States initially could feel less pain than China, but the reality is that they have a president for life who's already working on more pro-growth policies, a lot more fiscal stimulus. In fact, last week we saw that they're already pivoting, that they're walking away from deleveraging for the time being and focusing more on stimulus. In the United States, what we've already done is taken on more debt. We have a growing deficit. we fired our bullet in terms of tax reform stimulus. There's not a political will to do a lot more in the way of stimulus. Think about the pushback on giving some aid to farmers who have been hit by tariffs thus far. And so I would argue that China is far better equipped to play a long game than the United States is. And in fact, we could see the beginning of the end of trade wars in the U.S. with a midterm election that pushes out a blue wave.
Putting aside tariffs for a moment, because whether you have tariffs or not, August is not a great month for stocks, as I mentioned at the top of the show. LPL Research has actually looked into this. They see an average loss of 1% in the S&P 500 in August over the past 20 years. So what does a stat like that mean for our march back to the January highs? Sarge?
Well, this is where sell in May and go away comes from. I mean, there are 6 months that are usually stronger and 6 months that are generally weaker. You say 20 years down 1% for August. If you go 90 years, this is how I look at it. I go back to 1928. It's actually up small for August, but it's down, I think, 1% for September. So September over the long haul is actually the worst month. And these are the worst 2 months. October, in my own memory, is usually the worst month because I've gone through quite a lot, especially early in my career in October. But October is usually the month that we start waking up. And then you have your Santa Claus rally, which, according to Kristina's plan, I think could actually be a Santa Claus sell-off. If my theory about running up into the year end works, that's when people will be taking their profits.
But think about the next couple of weeks, right? Volume will be light. We won't have earnings, right? That will end in the next week or so. I mean, we saw what happened August 24th of 2015, flash crash, because we really had nothing to worry about. We started worrying about a devaluation of the yuan. So aren't we kind of setting ourselves up for some sort of end of August disruption?
I think there's the potential for disruption. And actually, I hearken back to a survey that Invesco did. We queried investors in January and we queried them again in April. And what we saw was that the February sell-off hurt confidence very significantly. In fact, in January, what we saw is 65% of investors said we're in a bull market. By April, having lived through that February sell-off, only 37% had the conviction to say we're in a bull market. And so I think that investors are walking on eggshells right now. They're less confident in this stock market environment. And so anything could really push them over the edge in terms of confidence.
Sarge?
Which might be the Fed, actually. I mean,
It could
we're talking
very well
about
be the
China and a
Fed.
few other things. The Fed, let's not forget, they're supposed to go up to $50 billion, I think, on the balance sheet normalization by October. From what I'm reading, they're not really on schedule to be able to meet that. They still want to raise rates, and they kind of have to the way the economy is right now. They want to raise rates, I think, September 26th and December 19th, and probably again in March. Although March, I don't want to get too far ahead, but the FOMC changes in a much more dovish direction.
Well, and it could be
point.
January if we have press conferences at every meeting starting
That's
next year.
true. I didn't even give that credence, but you're absolutely right. But the possibility is there that the Fed will force a policy error, and they've done it so many times in the past. That's usually where a recession actually originates, in my opinion.
But we've never really had someone like Jerome Powell
And that's a
in the
good point,
chair,
too.
right? I mean, someone who's really well versed in the markets. He's not an academic. I mean, does that make any
But
difference?
is that a good thing or a bad thing?
I think it's a very good thing.
Because while, I would argue that Chair Yellen was something of a nanny, right? She was soothing markets. She was very worried about every little change in economic data, and she erred on the side of caution. Jay Powell, I think of as the fun dad who certainly understands markets and has a high EQ. But at the end of the day, those are the dads who tend to throw their kids in the water to teach them how to swim.
Oh, he might do that.
And so, so it is. I mean, it
That
is
is not good for investors.
Exactly. And so
Investors like the water wings, right?
Investors love the nanny, the water wings, everything. And instead, I think we have a very different and new brand of FOMC chair, which has benefits over the longer term, could provide some negatives over the shorter term.
So then, if we do have an issue with the Fed potentially in the next 6 months, 6 to 8 months, what do you do with your portfolio? What do you make of the rally in tech over the past week or so? Especially Facebook, shares are up 7.5% just in August alone, and we know what happened at the end of July with that earnings report. So Sarge, weigh in on tech and Facebook.
Well, tech has always been a favorite sector of mine. Yes, I rotate in and out. I never go completely flat. My favorite names in the cloud space and in the semiconductors. I've never held a position in the equity space in Facebook. I think it's a poorly managed company, and I just don't go there. I will play it from the options space, but that's strictly on a 1 to 2 month basis. I think you have to be in tech. If you believe, as I do, that we're going to get at least 6 months out of this GDP ramp up, I believe you have to be in industrials, you have to be in financials, and you have to be in tech.
Kristina, what's your outlook for tech?
I'm still a big believer in technology. I think it's going to be such an important part of the future of the economy globally and in the United States. So, and of course, over the shorter term, tech has delivered in terms of earnings. Over the medium term, I think it will continue to deliver in terms of earnings. And many are surprised by what we've seen in the rally in the past week, particularly in stocks like Facebook. I think what everyone wants to see is that companies are doing something to avert greater regulation. And that to me was the takeaway, because regulation could be quite significant for some names within technology. So the more they can do to self-police, arguably the better.
Sarge, let's talk more about FANG, because you like Amazon and Alphabet, which, by the way, are two holdings of Jim Cramer's charitable trust, Action Alerts Plus. You like those names over Netflix. Why?
Well, I believe they both have real core businesses. I mean, even aside from AWS, the web services, you have one of the largest and growing retail businesses in Amazon. Google is the largest search engine. They can both sell advertising rather easily. When you come to Netflix, it's a real business, but they're going to run into Walmart now. They're going to run into Disney. They're going to run into this. They're running already into Prime. Netflix is going to run into tougher competition than they've ever had before.
What about Roku? I mean, that stock's
I like that
$56 a share, and you're getting 45% revenue growth.
That was a big screw up on my part, I tried to buy that last night, and my fingers weren't fast enough. I was too busy managing my Tesla short position.
Oh, we'll get to Tesla.
and I meant to buy Roku right ahead of the earnings because I had a feeling it was going to be good. And, I know a lot of guys will give you a load of crap, people. I'll tell you the truth. I missed it, okay? I tried to buy it. Now I'm trying to sell puts today. I'm trying to get short the put space so that I can buy it on a discount if it comes in.
But you wonder, why pay $185 for Facebook when you could pay $56 for Roku and kind of get the same revenue growth?
I wouldn't pay $185 for Facebook. I think that the last earnings report from Facebook proved to us that these guys don't know how to talk to people. They don't know how to manage. You see this kid, I guess he put on a suit 1 or 2 times for Congress, but he doesn't. He wears a hoodie, which I know that's not a big deal to a lot of people. It's a big deal with me, all right? When you go somewhere, when you talk to people, when you talk to investors, show respect.
Yeah, but you're only saying that because they had a rough quarter.
I'm saying that because I'm 54.
Harsh. Well, Kristina, when we talk about valuations versus revenue growth, how do you factor that dynamic in when you're picking stocks?
Well, I think it's a balance of the two, right? Because we have to recognize that there are some companies that if they can deliver really strong revenue growth, that they have wide enough profit margins, that's a place where you can go easy and be a little more flexible on valuations. Where you really want to be a disciplinarian on valuations is in areas where the profit margins are razor thin and valuations matter a lot more. So from my perspective, it's all about growth relative to price. And there are just some names where you do have to be more flexible on valuations.
What about growth versus value? That's a sort of theme we've talked about so much in the past couple weeks. Is it still in play?
Sure. If you like, just within the tech space alone, there's a lot of semiconductor names you can like on valuation. Yet, if you're going to also play the cloud names, you've got to be willing to look the other way on valuation. And I'm guilty of both.
You own NVIDIA, which is another holding of Action Alerts Plus. How do you trade NVIDIA ahead of the upcoming earnings?
Well, I am short a series of cascading puts to the downside in case the stock gets murdered. It's at a decent enough discount where hopefully I don't get hit and I can just use that money for lunch. But I am long the equity as well. And if there is some kind of pullback, I probably would add to the equity stake, like LPL Research here. It's down today. It's getting hit kind of in the mush a little bit. That one I have already added to, and I usually do add to it. That was my best performing stock in 2017. You're not supposed to become emotionally attached, but I am a little emotionally attached. So I have continued to play that game through this year.
Kristina, we've talked about this before, but should you sort of look under the hood within tech and separate FANG from the semis, from the cloud stocks?
Absolutely. It's not to say that any one of those areas is bad, but we need to understand the fundamentals and really look at the individual names, because there is some idiosyncratic risk. There are some companies that are going to do better than others, and so we need to be very, very well versed in the bottom up.
Even within FANG, right? I mean, there's different stories with all those members.
Oh, absolutely. There's a very significant differences between those few names.
There's a debate over whether Tesla is a tech stock or an auto stock, and it soon may not matter if Elon Musk takes the company private. Let's weigh in on what we saw this week with that tweet, which now we're hearing reports that the SEC may investigate. What is your reaction to
I'll tell you
Tesla
what my reaction was to that tweet. I shorted the name on that tweet. I was flat Tesla. I had historically lost money on my positions on Tesla, so I tried not to play the name. But that tweet was so unprofessional, and the series of tweets that followed it were so unprofessional, that I actually took a short position in anger, that I actually had to average up yesterday morning in order to get it to the right price. And today, I made some money, but I could have hit a triple and I hit a single because the stock has continued to come in. If the guy doesn't show us some proof that he has some funding, the guy's in some trouble.
That's what the SEC may investigate, whether or not that part of the tweet was actually truthful.
Yeah, well, I mean, this guy picked a fight with a rescue diver in Thailand. This guy's not all there. He might be the smartest guy on the planet, but he should not be running a large cap corporation.
And I don't think we've heard officially from the SEC, so we should be careful.
I'm not even going there. I'm just saying, as an investor, it made me root against him.
So what is your advice to folks who are still long the stock now? Because if they do get 420, I mean, that's a nice bump from where we are now.
If you're long the stock now and you've been long a long time, you've won the game. So I mean, I wouldn't get out of it because you might get 420, but I would not suggest, now that it's come in a bit, I would not suggest taking a short position, and I would not suggest selling options of any. I was asked this question specifically before I came on by someone else. I would not sell puts or calls. It's too dangerous. You could get held holding a bag way too large for yourself, especially on the retail side.
Although I think I read somewhere if you put $1,000 into Tesla in 2010 when they went public, you would have like $25,000 right now. So
yeah, I sold Amazon at 185 when I was a kid. Yeah.
There you go. Okay, Kristina, from a leadership perspective, what do you make of Elon Musk's behavior? I mean, when we see CEOs so comfortable with social media like that.
Well, I actually had thought that the American public had become comfortable with outlandish tweets. So I was actually surprised at the backlash because I feel like we've become somewhat numb to tweets and
I wonder why you say that.
I know, it's crazy. So actually, I mean, there are a lot of positives that you can say in terms of public good that have been done by CEOs like Elon Musk. The kind of foresight, the kind of thoughtfulness and the creativity that has gone into a lot of what they do. And so I'm willing to give them a little more leeway when they divert off the path. Certainly he's been having a bad month.
He changed fortunes for a lot of people that day.
He's definitely been having a bad month, but when I think about all the good that CEOs like Elon Musk do in terms of being visionaries for the future, I have to say they still earn some respect in terms of leadership.
Well, and to your point on folks being comfortable with a tweet, our own Jim Cramer made this point this morning about the SEC in that they view Twitter and, say, Reuters as the same type of communication. So they don't really care if you tweet like that. Obviously, they'll examine the content. But I think that's an important point, that we shouldn't necessarily be so shocked that he tweeted about the stock or he tweeted plans for his stock.
Well, it's only all right because that firm, Tesla, had stated in the past, they had made it public that this is a form that we will communicate with you. So from that point of view, legally, he's probably off the hook. But the content does come into question.
Yeah.
And he probably wants to use his communications team to vet tweets before he
should just
puts
hire
them
somebody
out.
to do his talking for him. Go in another room and do the thinking.
Kristina, let's talk about small cap stocks, because we've had this whole dichotomy in the markets where with the tariff situation, small cap stocks outperform. I mean, are you still bullish on small caps? How would you navigate that world?
I absolutely still expect small caps to outperform. This trade situation isn't going away, it's getting worse. And so while it makes sense to dive down and understand individual names, because there can be some small caps that derive a lot of revenue from outside the U.S., there are a good number of small caps that derive most of their revenue from within the U.S. And so domestic plays make a lot of sense. And of course, we can find some domestic plays in the mid-cap space. The key, though, is that the trade wars haven't gone away, and they look poised to get worse.
Do you have to go?
The rising dollar supports that, by the way. That's not just a trade war story, that's an interest rate story.
Absolutely.
Do you have to go so far into looking at small cap stocks under $5 a share? I mean, how do you position your small cap strategy?
Well, I think it's all about quality. And so you can find quality names under $5, but it's very much a fundamental bottom-up story, just as we talked about with other names.
Sarge, as co-manager of TheStreet Stocks Under 10 portfolio, what do you think of the small cap space?
I mean, it's still, you can find enough small caps that aren't so domestically exposed. And Chris Versace, my colleague over there that co-runs that portfolio with me, has a real winner in Habit Restaurants. I also like Energy Resources, which is ERII for our listeners, and ARCX, which is Acelrex. It's a pharmaceutical firm, only about $2.90 a share. They already had their major pain management drug pass European muster, and now it has to pass with the FDA sometime in November.
Because the other benefit to small cap stocks is they're going to get a lot of the reward from tax cuts, right? Because they were always paying a higher tax rate. So with that on the table, do you think that that benefit is priced in right now? I guess, how far are we in the tax cut sugar, so to speak?
I think that benefit is priced in, but we have to recognize that the tax reform package is a gift that keeps on giving for multiple years. In fact, if we were to look at the CBO's projections, it's expected to have its greatest impact on the economy in 2021, 2022, where it could really have give a significant boost to GDP growth. So is it priced in for the long term? I'm not sure. It's certainly priced in for this year and maybe next. But for the longer term, I'm not sure that small cap stocks have fully had that priced into them.
Yeah, Sarge, it seems like we still don't know the full benefit of the tax cuts that were passed late last year.
No, we really don't. But I think, remember Janet Yellen and Ben Bernanke used to speak about breakaway speed or breakaway velocity. We need to see that. We're at the beginning stages of an economy that has suddenly started to take off a little bit. And we need to see the breakaway speed before the fiscal picture catches up with us. And it's really, that's the trade war situation is something that could really stick the stick into the bicycle spokes where we could fall flat on our face. But this is what puts the pressure of time on the president's war with President Xi. Because these guys have to come, like you said, it's a time issue. Xi's there for life. President Trump may only have power for another less than 2 years.
Or 3 months if midterm elections go in a certain direction.
Exactly. I mean, and right now a lot of Americans are feeling very good about the economy. We don't really know if there will be a blue wave or it will be some mottled shade of purple. But it is real important to come to some kind of, I can't say resolution, but to at least get to the negotiating table with the Chinese where both sides can come away making believe they won.
Kristina, you mentioned the midterm elections. I wonder how investors should price that risk into their strategy, because we actually see data that shows that the market tends to rally in the year after a midterm election.
Well, the market has historically rewarded gridlock, and so we're likely to see gridlock with this midterm election. And I would argue that even though the administration has had some very strong pro-growth initiatives, that seems to be in our rearview mirror, that this year has been more about those initiatives that I would argue run antithetical to growth, like very strict immigration and like our trade policies. And so one could argue that this is not a bad time to have some gridlock because we've gotten many of the benefits of the pro-growth part of the administration's agenda.
Sarge, are you worried about the midterm elections from a stock point of view?
Yeah, I think, going forward, if there's gridlock, the markets do generally like that. I think there will be a negative backlash in the markets if there was indeed a blue wave. I think the markets are comfortable right now with Republican leadership. The people might not be, I don't know, it's up to them. But the markets generally seem quite okay with it.
Although I think markets were much more positive last year than they are
well, it was
this
still
year.
in the future last year.
Right, exactly,
So-
for sure. But that tells us what markets expect of the future now. And so my expectation is that we won't see much change if there's a blue wave.
Is that because we didn't have those trade worries right in our faces at this time last year?
Exactly.
And maybe we were focused on
Tax
what could
reform,
come
which was
from tax
exciting.
cuts. Yeah.
Absolutely.
You
We
agree?
should have seen him coming, though. I mean, the president has said this not only since he ran for the presidency, but since he was much younger. So he's always believed in I don't want to say a more protectionist agenda, but I guess for lack of a better word, that's what I have to say. It's been his belief for a long time.
And there's no evidence that he's changed his tune on tariffs in any way, even with some of the market reaction that we've seen from those headlines.
That's correct. And the whispers from lobbyists are that the anti-globalist faction within the White House has really taken hold and is in charge of trade policy. So that suggests to me that we are moving full speed ahead towards a full-blown trade war.
Okay, I want to end with some unexpected events that could disrupt the market. So, I mean, maybe it's tariffs, but what are we missing here? What's not on our radar that could really disrupt the march to 2873 in the S&P 500? Sarge?
It'll either be like I said, a policy error by the Federal Reserve, or a geopolitical mistake, something where a North Korea where it goes the wrong way, or an Iran makes a war-like decision somewhere in the Gulf. Something like that, I think, would cause, it would make my defense stocks rally, and they've been in a hole lately, but that's about the only good I can think of it.
Because we have new sanctions against Iran and Russia, by the way.
Yeah, Russia cannot be very happy. I mean, but you know what? The president, I think he's trying, because of the news flow, I think he has to take an extra aggressive stance where that is concerned, and so that he has to go there, and that's something that the ruble is going to have to live with.
Kristina?
So I would dive down specifically into Fed policy error and focus on balance sheet normalization. QE was an enormous experiment, and so the unwind of QE is an experiment in and of itself. And what we're already starting to see is that it's creating a liquidity suck. It's affecting most directly emerging markets. But if the Fed continues on its plan for balance sheet normalization, that situation, the kind of pressure that's being placed on liquidity, could be exacerbated, and that to me is probably the greatest risk right now.
So then do you disagree with Janet Yellen's comments when she famously said that the unwinding will be like watching paint dry?
I absolutely disagree with them. I think she tried to be as prudent as possible in terms of rolling out a very measured and careful plan. I think she believed at the time that this was perhaps the best approach, that it was measured, that it was thoughtful. But her argument that it could occur in the background while Fed funds is the key tool, I just don't believe that's the case.
That scares me as well. I really would prefer, if you suddenly let me have the chair of the Fed, all right, I would probably, before the end of the year, either stop with the rate hikes or slow down the normalization of the balance sheet, because I really do not like doing both at the same time. I realize you got to go there. You got to try to do this while the economy's hot. But I really am uncomfortable with this balance sheet normalization that is running right now in the background, but we're only down to 4.2. All right, when did we start at 4.5? We haven't really come that far.
$4.2 trillion.
Right, it's still a large balance sheet. They're already finding some stickiness in mortgage-backed securities.
Don't say that phrase.
Well, it's not running as smoothly as unwinding the Treasury balance, that's for sure. I don't know where we go from here. Maybe I'm not that smart, but I am smart enough to be scared by it.
All right, guys, we'll certainly be watching it. Thank you very much to both of you for joining me.
Thank you.
Anytime, Doctor.